Hello, welcome back to Am I Catching a Falling Knife? The podcast where we break down market moves and help you understand if a recent dip is an opportunity or a warning. I'm your host, Dave, and today we're putting a true global giant under the microscope, United Parcel Service, ticker symbol UPS. Now, UPS has seen a noticeable slide recently, down about 8.73% over the last few days. So the big question is this a temporary stumble for a titan, or are we looking at a genuine falling knife here? Let's dig in. Well, the dominant market narrative right now is all about macroeconomic uncertainty. This led to a rare profit miss for UPS, and to top it off, they've withheld full-year guidance for the second consecutive quarter. This uncertainty has really overshadowed some otherwise positive news, like better-than-expected revenue and some smart cost-saving initiatives they've been implementing. But let's not just focus on the recent dip. What exactly is UPS? United Parcel Service is a global behemoth in logistics and package delivery. We're talking about a company that serves over 200 countries and territories, manages a massive network with more than 500 planes and 100,000 vehicles, and delivers roughly 22 million packages daily. Their core operations are split into U.S. domestic package, which accounts for about 65% of their revenue, and international package, making up around 20%. They also have a supply chain solutions segment at 15%. Beyond just delivering packages, they're involved in air and ocean freight, contract logistics, customs brokerage, and even healthcare logistics. Their strategy is crystal clear: customer first, people-led, innovation-driven. Now, let's dive into the core of the issue, that profit miss. How impactful was it? The market narrative clearly states a rare profit miss and them holding back guidance for a second time. For a company as stable and large as UPS, these are strong signals of significant and persistent pressure on their profitability. The profit pressure primarily comes from broader macroeconomic uncertainty, which, as you can imagine, impacts package volumes and pricing power right across their main segments, both domestically and internationally. Even with revenue coming in better than expected, the fact that they missed on profit implies that their cost management or pricing power just couldn't fully offset those underlying volume or operational cost challenges in their core areas. A rare profit miss for UPS, combined with consecutive quarters of withheld guidance, signals a material deterioration in their earnings outlook. This isn't just a small blip. It suggests the negative factors are substantial enough to create significant uncertainty and really outweigh any operational improvements they've made. So, after crunching the numbers, we're estimating a substantial double-digit decline in their quarterly earnings. Considering the broad impact across their core segments and management's own lack of forward visibility, we're looking at a decline in the range of 15% to 25% relative to prior expectations or year-ago performance, centralizing our estimate at about a 20% negative impact. And that confidence interval is relatively wide, precisely because of that high degree of uncertainty highlighted by UPS's decision to withhold full-year guidance again. Now, to figure out what this stock is really worth, I'm looking at it from two angles, using data I pulled from finviz.com. First, a discounted cash flow model. In our base case, we're assuming a growth rate of 3.2% for the company's earnings, a discount rate of 9.5% to factor in the time value of money and risk, and a terminal growth rate of 2.5% for the long term. This gives us a base value of about $101.55 per share. But then we apply our narrative's impact, that estimated 20% earnings decline, and that brings our narrative-adjusted DCF value down to roughly $76.16 per share. The second method is a bit simpler, a PEG-based valuation. This method looks at the price-to-earnings ratio relative to the company's earnings growth rate. For UPS, with an EPS of $6.73 and a projected 5-year EPS growth of 3.2%, this gives us a fair value of a much lower $32. It shows how growth, or the lack thereof, can dramatically influence valuation. For some context, UPS has an annual revenue of over $91 billion, free cash flow of $5.37 billion, but also carries about $25.59 billion in total debt. Their gross margin is around 17%. So, what about potential entry points, if you're thinking of catching this falling knife? Based on our models and considering the current uncertainty, I've got some custom buy levels on my radar. These are $70, $50, and $30. These are the levels where, for a long-term investor, the risk-reward profile starts to look much more appealing, especially if we see continued weakness or a clearer picture emerges on their future profitability. All right, that wraps up our deep dive into UPS. As always, this isn't financial advice. It's just me, Dave, sharing my thoughts and analysis. Do your own thorough research, consult with a financial advisor, and make decisions that align with your own financial goals and risk tolerance. Thanks for tuning in to Am I Catching a Falling Knife? And until next time, keep those portfolios sharp.